Here we have extended portfolio balance model to the exchange rates and the BOPs. This is an extension of the basic portfolio balance model, basic portfolio balance approach to the BOPs adjustment and exchange rate determination. So this is the basic portfolio. The individuals and the businesses are supposed to hold their portfolio in the form of money, domestic bond and foreign bond. That means the money is kept in the form of money itself, or in the form of domestic bond, and or in the form of foreign bond. So this is the three financial assets on which the money is kept. So let's look the demand for each asset in the portfolio. So we are going to look at the extended portfolio model. In the extended portfolio balance model to the exchange rates, we consider the factors driving the portfolio adjustment. The factors determining the portfolio are real income represented by GDP, real GDP. Second one is price level represented by P. Third one is wealth, that is W. Fourth one is expected appreciation of the domestic currency represented by EA. Fifth one is risk premium. Risk premium is the amount of money paid to avoid the foreign exchange risk involved in the investment on the foreign bond. So when risk premium is higher, so we will consider what effect will it make on the demand for each financial asset in the portfolio. So next one is domestic rate of interest, that is the rate of interest on the domestic bond represented by I. Last one in the list is foreign rate of interest, that is the foreign rate market rate of interest on the foreign bond. So these are the factors driving the adjustment of portfolio. So initially let's look the demand for money. So money is an asset in the basic portfolio. Here we have the factors driving the demand for money. Let's write the demand for money as M is equal to the function of I star, EA, RP, Y, P and W. So these factors are determining the demand for money in different directions. One is first one in the list is I. I stands for domestic rate of interest or rate of interest on the domestic bond. It is negatively related. You can see there is a negative sign is given along with I. I is the domestic rate of interest. So when domestic rate of interest is higher, demand for money is lower. So that is the meaning of the negative sign. So how does it happen? So when domestic rate of interest is higher, when domestic rate of interest on domestic bond is higher, demand for domestic bond will be higher and demand for money will come down as more money will be used for purchasing, investing in domestic bond. So demand for money will come down. Second factor is I star. I star is a foreign rate of interest or rate of interest on foreign bond. So when rate of interest on foreign bond is higher, demand for foreign bond will be higher, but demand for money will come down as more money will be invested in foreign bond. So demand for money will surely come down. Third factor in the list is expected appreciation denoted by EA. Expected appreciation here refers to expected appreciation of the domestic currency. If expected appreciation of domestic currency is higher, the demand for money will come down, as when expected appreciation is higher, the investors who invested their money in the foreign bond will be the beneficiaries. So the demand for foreign bond will increase, then the role of money in the portfolio will come down, and so it is negatively related to the demand for money. Next is RP. RP is the risk premium paid for hedging the foreign exchange risk. So the investment in foreign bond involves the risk of expected depreciation of the currency. So when currency is depreciated heavily, the investors who invested their money in the foreign bond will make loss. So they suffer loss. So when, in order to avoid that loss, the risk premium could be paid. So when risk premium is higher, so when risk premium to be paid on foreign bond is higher, the more money will have to be spent for paying the risk premium. Then demand for money will be come down for sure. Next one is income. So whenever the income, money income, income or real income of the people, of the businesses, of the economy increases, the demand for money will increase for sure. As high income, high demand for money, it is normal. Then when price level, the next is price level in the economy. When price level is higher, or when there is inflation, more money will be used for keeping it in idle form. So demand for money will increase to meet the extra requirements due to higher prices or inflation. Next is wealth, represented by W. So wealth is positively related to demand for money. Higher wealth, higher demand for money. Second asset in the portfolio is domestic bond. So let's consider the demand for domestic bond. Demand for domestic bond is a function of I star, EA, RP, Y, P and W. And first one is I. I stands for the rate of interest on domestic bond. Here we are considering the demand for domestic bond. When rate of interest on domestic bond is higher, demand for domestic bond will also be higher. As domestic bond is offering higher rate of interest, demand for that asset will increase for sure. Second one is I star. I star is the rate of interest on foreign bond. Whenever the rate of interest on foreign bond is higher, demand for foreign bond will increase, but demand for domestic bond will come down as more money will be invested in the foreign bond. Then third one is expected appreciation of the domestic currency. So when there is an expectation, when there is higher expectation for the domestic currency to be appreciated in the future, then what will happen? So when there is an expectation of the appreciation of the domestic currency, then the investors who invested their money in the foreign bond will be the beneficiaries, as they will get, as their asset, as the value of their asset will increase when there is an appreciation of the domestic currency. So for sure, the demand for foreign bond will increase when there is higher expectation of the appreciation of the domestic currency. At the same time, domestic bond demand will come down as more money will be invested in foreign bond. Next one is RP. RP is the risk premium. Risk premium, whenever the risk premium is higher, the demand for foreign bond will come down. That money will be kept as idle here, then demand for money will increase. So Y is the income. Higher income means higher demand for money. So whenever demand for money is increasing, the demand for domestic bond will not increase, it will decline. Next one is price. So whenever the price level is higher, demand for money will be higher, but demand for domestic bond will come down, as the total money will be kept in either in money form or in bond. Last one is wealth. So wealth is positively related to domestic bond. Higher wealth, higher demand for domestic bond. The third and last one in the portfolio is foreign bond. Let's consider the demand for foreign bond. Foreign bonds demand is written as, it is a function of I star, EA, RP, Y, P and W. So these are the factors driving the demand for foreign bond. Foreign bond, as I said, is one of the assets in the portfolio as per the portfolio balance model. So let's look the first factor, which is I is the domestic rate of interest or the rate of interest on the domestic bond. So whenever the rate of interest on domestic bond is higher, the demand for domestic bond will increase, but the demand for foreign bond will come down for sure. Second factor is I star. I star is the rate of interest on foreign bond. When foreign bond is offering higher rate of interest than the domestic bond, then demand for foreign bond will increase. So it is positively related to foreign bond. Next one is EA. EA is the expected appreciation of the domestic currency. So when domestic currency is supposed to increase in the near future, then the people will have higher tendency to invest in foreign bond, as their foreign bonds value will increase after appreciation of the domestic currency. So it is positively related. Next one is RP. RP is the risk premium to be paid for avoiding the foreign exchange risk involved in the investment on foreign bond. So whenever higher risk premium is to be paid, then the attraction of foreign bond will come down. Demand for money will increase, but demand for foreign bond will come down. And next one is Y. Y is the income. Whenever the income is increasing, the demand for money will increase, and the demand for foreign bond and domestic bond will come down. Next one is price, represented by P. P stands for price level in the economy, domestic price level in the economy. When there is inflation in the economy, demand for money will increase, as they need more money to meet their requirements after inflation. Then the demand for bond, both foreign bond and domestic bond, will come down. Last one is wealth. So wealth increases, demand for bond, both foreign bond and domestic bond will increase. So these are the factors affecting the three assets in the portfolio: money, domestic bond and foreign bond.